The company name is Arlington Industries. The topic is performance measurement, and with that topic we know it's Part 1, Section C, and specifically the topic performance measures. We'll go ahead and start reading the information we have. 5 years ago, Arlington Industries expanded vertically by acquiring one of its suppliers, Raddix Plastics. Arlington monitors its divisions based on both product contribution and return on investment, ROI, with investment defined as average operating assets employed. Okay, so average operating assets employed. All investments in operating assets are expected to earn a minimum return of 11% before income taxes. Management bonuses are also determined based on ROI. So it's ROI that's providing that bonus for management. The cost of goods sold at Raddix is fully variable, while administrative expenses are not dependent on sales volume. So if they're not dependent on sales volume, those administrative expenses are fixed. And selling expenses are mixed cost with 40% attributed to sales volume, which means 60% is fixed and 40% is variable. Since Arlington acquired Raddix, the ROI at Raddix has ranged from 11.8% to 14.7%. During the fiscal year just ended, Raddix considered a capital acquisition with an estimated ROI of 11.5%. However, division management decided against the capital acquisition because it believed that the capital acquisition would decrease the division's ROI. Now, that all depends on what the division's ROI is right now. If the division's ROI is above 11.5%, yes, it would decrease it. If the division's ROI is below 11.5%, then this investment would actually increase it. The abbreviated most recent income statement for Raddix is presented below. The division's operating assets employed were $15,750,000 at year end, which was a 5% increase over the previous year-end balance. So previously it was less than $15,750,000, and we'll get to the math in a little bit about that. So we're given some information. Here's their income statement. We have sales revenue, $25 million. We're going to leave our three zeros out of all of this. We're told cost of goods sold. Now remember, cost of goods sold was a variable cost. Okay, we're told the administrative expenses, and again, remember that was a fixed cost, just putting this in here to help us remember what we have. And then we said our selling expenses were 40% variable. Okay, so those are the costs. And our income from operations, $1,845,000. So that's the information that we're given. We have 6 requirements that we have to go through. So we'll just kind of look at these before we start. First, calculate the unit contribution margin for Raddix Plastics if 1,484,000 units were produced and sold during the fiscal year ended December 31st. So that's just putting a number of units to that income information we were just given. 2, based on the average operating assets employed, calculate the ROI and residual income for the Raddix Plastics division. 3, explain why the management of Raddix Plastics would have been more likely to accept the proposed capital acquisition if residual income rather than ROI was used as a performance measure. 4th, identify one disadvantage for the organization to focus only on ROI and residual income respectively. So we're looking for one disadvantage. 5, Raddix Plastics is a separate investment center within Arlington Industries. Identify 3 other types of responsibility centers. Now, when you read this, you should be happy about this. This is an easy question. Identify 3 other types of responsibility centers. They've told you one, it's an investment center. So all you need to do is list the other 3 types of responsibility centers, and we'll do that when we get to requirement number 5. Requirement number 6, identify the items that Raddix should control if it is to be evaluated fairly by using the ROI or residual income performance measure. So we've got a few questions here with numbers, not a lot. Some theory questions, just kind of in general what's happening. So we'll go ahead and start with requirement number 1. We need to calculate the unit contribution margin for Raddix Plastics if 1,484,000 units were produced and sold during the fiscal year ended December 31st. Okay, what we're going to do is go back and look at, here are just our income statement that we were given, and we've got this information here about what's a variable cost, what's a fixed cost, and what with our selling expenses was that mixed cost. And this is the information that we just need to put into revenue minus variable costs equals contribution, total contribution, and then we're going to divide that by the number of units to get the unit contribution. Okay, what we're looking for is the unit contribution. So our formula, total revenue minus the variable production costs divided by the number of units. Okay, that's what our formula is. That's the information we're looking for. And this information is given to us. The total revenue we know, $25 million. We know that we had $16,500,000 of cost of goods sold. That's what this number is. And we know that 40% of the selling costs were variable. Okay, so we go a little bit further. We know that there was $7,420,000 of total contribution. We need to divide that by the number of units. And again, we're leaving the 3 zeros off here, but as long as we leave them off everywhere, it doesn't matter. And we get our unit contribution margin for Raddix Plastics was $5 per unit, given the assumption that 1,484,000 units had been sold. Okay? The information's there. We just need to recognize out of those costs, cost of goods sold, administrative expenses, and selling expenses, which ones are variable and which ones are fixed. And we started right from the very beginning doing that. So that's requirement number 1, $5 per unit. Requirement number 2, based on the average operating assets employed, calculate ROI and residual income for Raddix Plastics division. So our formulas, ROI is operating income divided by average assets. Residual income is the operating income minus the minimum required return on those average assets. So we need to calculate average assets. And remember, they told us that it was $15,750,000 at the end of the year, which was 5% more than at the beginning of the year. And so this $15,750,000 is the ending, and we need to calculate the beginning by taking away 5% of that. And so we do the math. The beginning was $15 million, $15,750,000 plus $15 million divided by 2. Our average assets was $15,375,000. Okay, just a nice simple calculation there. We had to do a little bit more because they didn't tell us that the beginning was $15 million. We had to calculate that, but it wasn't that difficult. So now we can calculate both ROI and residual income. ROI, again, is the operating income divided by the average assets. Well, we were told $1,845,000 was the operating income. That $15,375,000 we just calculated. And so the ROI, 12%. Okay, nice, works out nice and evenly. And now we can calculate residual income. That's the operating income minus that required return on average assets. We were told at the beginning that it's 11%. So if there was $15,375,000 of average operating assets, 11% of that is $1,691,250. That's what the minimum required return was. Now, we achieved $1,845,000, which means we, I don't know if overachieved is the way of looking at it, but we exceeded that minimum required by $153,750. So our ROI, 12%. Our residual income, $153,750 was our residual income. So those are the calculations. We just need to take the information that's given. As I advise, write down the formulas you're going to use. Make certain you have them written down. It makes it easier to put the numbers into them if you know exactly what it is that you're looking for. Requirement number 3, explain why the management of Raddix Plastics would have been more likely to accept the proposed capital acquisition if residual income rather than ROI was used as a performance measure. Well, there's different ways we can say this, but the answer was Raddix management would be more likely to accept the proposed capital acquisition if residual income was used as a performance measure because the acquisition would have increased both the division's residual income and management bonuses. Okay, if we'd accepted this, this is what would cause them to do it. Okay, we'd be more likely to accept the proposed capital acquisition if we'd used residual income. Using residual income, management would accept any investment with a return higher than 11%, as all would increase the dollar value of residual income. With ROI as a measurement, Raddix would reject any investment with a return lower than 12%, as this would lower overall return and lower bonuses. So if we use ROI, this investment has an ROI of 12%, and we were told that management, Raddix had 12%. This investment that we're looking at is 11.5%. And so if Raddix were to make this investment based only on ROI, they're going to refuse it because they're currently at 12%. You add 11.5% to that, their ROI comes down, and as their ROI comes down, their bonus comes down as well. But if we were using residual income, if this proposed investment, not the one we just calculated Raddix's, but if this proposed investment had a positive residual income, they would accept it. More money. But if ROI is what their income, what their bonus is based on, this project is not going to be accepted because this project has a lower return on investment than they currently have as a company. So it would reduce management bonuses. Requirement number 4, based off of this, identify one disadvantage for the organization to focus only on ROI and residual income respectively. So our residual income is a flat dollar amount, which makes comparing business units of different sizes difficult. Okay? That's a disadvantage of residual income. ROI may lead managers to reject investment opportunities with a lower ROI, which is lower than current or target ROI, but is strategically beneficial to the organization as a whole. If management is basing its decisions only on ROI, it may reject this potential investment of 11.5%, even if this potential investment is a great strategic opportunity, even if that 11.5% is billions of dollars, because ROI is going to come down. Okay, so clearly we shouldn't be using only one or the other as the only tool that we use. Managers will tend to minimize the investment base for these measures, which includes discretionary costs such as research and development, quality control, maintenance, human resources development, and advertising and promotion. Cutting these costs will increase short-term ROI and residual income, but may create long-term problems for the department or organization. Now, that's kind of additional information there, but our residual income is a dollar amount. We can't compare different size units. ROI may lead to poor long-term decisions trying to maximize the ROI for a division. Requirement number 5, this was the easy one. Raddix Plastics is a separate investment center within Arlington Industries. Identify 3 other types of responsibility centers. Well, this is easy. 3 other types of responsibility centers are cost center, revenue center, and profit center. It only tells you to identify them. It doesn't say identify and define. It doesn't say identify and explain. Just identify. And so here we have our answer. We're going to number it 1, 2, 3 so they see that we have all 3 of them. Cost, revenue, profit center. Full points for this. It doesn't take long. It shouldn't take long. And that then leads to the last requirement. Identify the items that Raddix should control if it is to be evaluated fairly by using the ROI or residual income performance measures. Well, before we look at this specifically, anything that we're being evaluated on, in order to be evaluated fairly, it needs to be something that we can control. If we can't control it, we don't have any influence over it, then it's not really fair to evaluate us on it because we're not able to do anything to control how that evaluation is going to come out. And so, to be evaluated fairly as an investment center, Raddix must control all items related to profit and investment. The division should control all elements of the business except the cost of invested capital, which would be controlled by Arlington. Okay, we're not the ones issuing the debt or issuing the shares or borrowing the money, but we should be able to control everything that's related to profit and investment. Okay, if we're a cost center, we should be able to control the costs. We just need to be able to control whatever it is that we are being evaluated on. So we've got 6 requirements. One of them, the 5th one we said, was very, very simple. Again, the information's there. It's just a matter of identifying what's the formula for ROI, what's the formula for residual income, what is it that each of these are measuring, and identifying out at the beginning there which of those expenses are variable costs, which are fixed, which in this case had some that were mixed. But it's just a matter of using that information, writing down the formulas at the very beginning. When you see you need to do ROI, you see you need to do residual income, just quickly write down that formula so you don't blank on it later when you're trying to make that calculation. You have that written down, you take the information as you're reading the question, and it makes it easier to understand what you're going to do with all of that. But again, nothing individually difficult in this. Again, even if you missed one of the calculation questions, you can still get the other questions, the theory questions about ROI and residual income. So make certain that you continue to answer, even if one of the earlier requirements is one you're not able to. Keep answering, even if you didn't know anything else. If you knew the different types of responsibility centers, you would have gotten the points for that. So make certain you answer what you can. Try not to leave anything blank, because if you leave it blank, you will get 0 points for that. And we want to get as many points as we can, which we maximize by answering everything that we're able to, even if it's not all of the requirements or all of an individual requirement that we're asked about.